categories.
Sure. Thank you so much, Mr. Ratnam, as well as Satish, for coming in and speaking to us, giving us this perspective, and wishing you all the very best. Day one of the IPO Open.
Yes.
In fact,
thank you.
2 minutes.
Thank you.
Past 10.
Thanks a lot.
So,
Thank you.
We'll see you soon. Anyway, viewers, what we'll do is we'll slip into a very short break, and we'll have Dixon on the other side. In fact, we already have Saurabh Gupta. He's director and CFO at Dixon Tech, joining us of a margin trim, and part of that I believe is because of mobile phones. And just talk to us about what's played out in this quarter with regard to phones and with regard to margins.
Sure. I think so. The margins got impacted mainly on account of three factors. One, of course, our mobile PLI 1.2 got expired in March, and now another mobile PLI 2.2 which has come in. It will take a couple of months for us to get those numbers into the system. Secondly, there were inflationary pressures across the commodities and supply chain. So one, the memory prices impacting the mobile phones. Of course, it's a pass-through. But since it's a pass-through, the margins, because of the increase in selling prices, largely on account of the memory prices going up, the margins optically look lower. And third, I think so, our input cost increase and the polymer cost increase across our washing machine portfolio and refrigerator portfolio, which is part of our ODM business, there we saw some margin compression. So these are largely three drivers why the margins got contracted. But we feel it's kind of a temporary impact. And ultimately, the margins in washing machine and refrigerator, there is a pass-through mechanism. And we are working a lot on also driving a lot of efficiencies in that business.
So does that pass-through happen immediately, in the sense Q2 itself? Will we start seeing the numbers looking materially different in terms of the margin picture?
I think this large part of it hopefully should get passed on. It gets passed on with a lag. But for us to effectively pass on completely, the commodity cost needs to come down. But seeing the situation on the crude side, because polymer being a byproduct of crude, we see that it may take some time. But yeah, gradually and slowly, those will keep getting passed on here.
Saurabh, how do you look at the memory, memory prices? Because that's also something which is remaining elevated, and with the kind of AI demand and the semiconductor demand which is coming in, it's unlikely that that memory prices are going to come down anytime soon. And how are you trying to hedge that? And is memory prices also gets passed through to the customers?
Yeah, so one, it's a complete pass-through. What we get is a per piece conversion charge. So the commodity cost or the memory cost increase, it's completely passed through. What it optically looks like, our margins optically look lower, because if you are making a per piece conversion charge and if the commodity cost mainly on account of memory goes up, then your margins optically look lower, which is exactly what happened in Q1. So you're absolutely right. I think so. These memory prices are not coming down, at least in the near future, because of a lot of investments happening on the AI side. And clearly, the memories are allocated more there, and the margins there are much more superior. And the capacities in the short term don't come by. They take time. There's a long gestation projects. So we feel that the prices for mobile phones will continue to be on the higher side, at least for some period of time, which will, of course, have some impact on the margins as well. Yeah.
And, do you see a reason to do a hedge here, because you have currency pressure also coming in here as well? Is that something that you follow at Dixon?
See, we don't do a hedging of commodity. Basically, the memory prices is complete pass-through. So there is no point hedging it, because it's a low margin business for us. Secondly, as far as the currency is concerned, so almost 90% of the overall revenues that we have, there is either a natural hedging or the cost of hedging is passed on to the consumers. Only 9 to 10% of our FX exposure is open, which we try to hedge sometimes, depending, we take a call. But yeah, large part of our business is automatically hedged and passed on to the customers.
What's exciting in the market is the backward integration that you're doing. Do you think margins will restore to the normal levels in FY27, given the kind of work that you're doing on backward integration?
So we feel that of course, our capacities for display should be up and operational by Q4, and then the ramp-up stabilization should happen by Q1 of next financial year. and every quarter the number should keep going up. Our camera business, where we are expanding the capacity and also putting capex for deepening of manufacturing, that is in the progress right now. And so we feel that 28, 29, we should, on account of both this backward integration projects, we should expand our margins by 100 basis point plus on the mobile side. And 27, 28, I feel that almost 40 to 50% of that should start reflecting in terms of the margin expansion. So definitely not this year, but definitely from next year, the margins will start to expand.
You're also pricing in Vivo coming on stream as part of this margin increase, I believe.
Yeah, Vivo should start reflecting in Q3, H2 of this financial year. And the annualized potential for Vivo is quite immense. They are the number one player in the smartphone market in India. So we feel that next financial year, it can add almost 35-40,000 crore revenues to our numbers. And this year, let's see how much we can maximize in the H2 of this financial year. So we are working closely with them to close the transaction, and hopefully it should start reflecting in Q3.
What is the kind of volume that you're penciling in for FY27 and 28 for Vivo?
So 28, we should be closer to somewhere around 20 million plus. And this fiscal year, we will target, if we are able to do a 35-40% of that. We're targeting that kind of numbers.
Okay. And just a couple of follow-ups with regard to Vivo itself. So it'll add around 35 to 40,000 crore in terms of top line. Does it increase your average selling price with regard to mobiles? I know you gave numbers, but just give us a perspective on that, on this as well.
Yeah, it should definitely increase. Vivo is slightly more on the premium side, so the average selling price of the combined mobile portfolio should go up.
And memory prices have inched up, and in fact, not just inched up; they've literally flown. Do you expect any cool off anytime soon, or this is going to be something which is slightly long drawn?
I feel it will take some time, as a lot of capex happening on the AI side. So I think the demand for memory will continue to be on the higher side. But it's very difficult to predict. But yeah, I think so in the short and medium term, I don't think so memory prices are coming down.
And how much of these memory price increases are being absorbed? Maybe not at your level. I mean, you clearly stated that there's a pass-through at your level, but by your customers, and how much has been passed on to the ultimate consumer? Just if you have a perspective on that.
Yeah, so I think a lot of that has been passed on to the ultimate consumer. So if you look at all around, the prices of the mobile phones have gone up by 35-40% on an average. And clearly we are seeing that as per the various reports, the overall smartphone market will contract from 150 million to almost 10 to 15%. And Dixon, despite the market getting contracted, we are hopeful that excluding Vivo, we will maintain our volume numbers for this fiscal.
Saurabh, you also have a significant stake in Aditya Infotech, and the fair value calculation also helped push the PAT as well. Is there a plan to monetize that stake?
So we've already monetized some part of that stake. We are left with around 2.5% kind of a stake in that company. So as of now, we have not taken a call, but yeah, at some point of time, we may look at monetization.
So will it happen in this financial year, or you'll push it to the next financial year? It's around 2.4% stake, right?
It really depends on whether we require that kind. The company is doing really well, and they have a strong growth potential. So we'll take a call. We have not taken a call on that.
Okay, Saurabh, thank you so much for joining us and giving us that perspective. We'll let you go.
Thank you so much. Thank you.
Okay, let me bring on board Basudev Banerjee on the other side of a very short break that we're going to be taking. He is senior research analyst, covers auto closely at CLSA India. Basudev will come to you in just a couple of minutes. Take a quick commercial, come back, talk to him. Welcome back, and we're joined by Basudev Banerjee, Senior Research Analyst at CLSA India. Basudev, thank you so much for waiting by very patiently. it's corporate earnings season time, and things can be very tricky when it comes to live TV. But let me come to you straight off with regard to the Q1 numbers. They've been very robust, right? The GST rate cuts that have happened still translating to good demand on ground. Do you believe that's the only or one of the only components which is driving the kind of numbers that we're seeing?
Yeah, hi, morning. Thanks for inviting me. So one needs to differentiate between two aspects. One is it's not only about growth. One needs to look about profitable growth. So one section of the industry which has been growing in excess of 20%, with hardly being able to take a 1% price hike. And another section of the industry which is growing at an equivalent pace but have taken much superior price hikes. So the quantum of margin damage along with this kind of volume growth, that one also needs to focus on rather than just looking at the volume growth aspect.
Basudev, hi, morning. Sajid here. Do you see some bit of moderation in growth coming in because of the base effect starting from August, September?
So see, that is very much known and nothing surprising. So the kind of 25% growth which PVs or two-wheelers are witnessing today, that is a combination of, obviously, as you highlighted, the GST cut, plus the very subdued market sentiment, which resulted in weak base in first half of CY25. So anyways, most of, we believe that the prices are not at all building in proration of these kind of 20% plus growth. So stock prices are more or less pricing in a logical kind of industry growth situation. So I don't see that the transition from 25% growth to a single-digit growth would be detrimental from a outlook perspective or consensus earnings perspective.
And where do you see a pressure coming in? Do you see some margin pressure coming in now? Because beyond a point, many of the companies may not be able to transfer the cost escalation or raw material price escalation to the consumers because it may start impacting the volumes for them. Do you see that kind of pressure getting absorbed by some of the companies?
So if you actually see the we came out with analysis of the quantum of price hikes required, with steel prices being higher 20%, aluminum prices also being higher 25%, Brent crude, natural rubber prices, as you know, the way they have moved, which meant somewhere around 6-7% price hikes at ex-factory level in general. And few spaces like commercial vehicles or say a few utility vehicle makers have already taken 4 to 5% price hikes. And if you look at since June, Brent has corrected from 110 levels, aluminium has corrected almost 15-20%, which means no more it is required to take a 6-7% price hike. So somebody who has taken a 4-5% price hike is good enough to sail ahead in terms of business and take benefit from the festive season ahead. So I don't believe that further incremental margin pressure would be there with players with good pricing power or who are beneficiary of a weaker local currency.
Basudev, just with regard to price hikes, you believe that a lot of the commodity price inflation will get offset with the kind of price hikes that most have taken already? And is there scope for more price hikes? And the impact of that on demand, you reckon, what would that be?
I will say that across the two-wheeler space, the discipline of price hikes have been quite robust. Across the commercial vehicle space, the quantum of price hikes have been quite robust. It is the mass market passenger vehicle space where despite volume growth of 20-30%, the quantum of price hikes have been quite subdued. Barring that, in all other spaces, even in tractors, price hikes have been quite strong. So from a margin outlook perspective, I believe it's high time that mass market car segment one should not be surprised to see incremental price hikes. Rest of the segments have already taken commensurate hikes.
How do you look at the EV penetration? Because we saw a tailwind for the EV penetration in the Q1 led by the geopolitics or price energy cost increase which came in. Do you see that tailwind to sustain in FY27?
Yeah, so if you look at historical trajectory, typically the FAME subsidy used to get revised every year sometime around April. And that resulted in a shock and the EV penetration did not pick up for a few months and it used to go on like that. Now with your FAME subsidy or PME drive scheme, which got, as per media reports, extended today, is barely at 5,000 rupees per unit for an e-two-wheeler. So there is natural progression in acceptance of electric two-wheelers now. And it's no more a FAME subsidy-driven acceptance. So from that perspective, as you rightly highlighted, that gasoline prices have moved up, new alternatives of Class E two-wheelers are coming into the market, and customers are happy where equitable TCO products one getting with far richer features. So from that perspective, we believe e-two-wheeler penetration definitely has a huge scope to go ahead in next 4 or 5 years. And also the bigger part is passenger car electrification, where acceptance was very muted and alternatives for customers were also very limited. Now in trailing 12 months, lot many new launches have been happening, and in next 12 months also a lot many new launches planned. So we believe that rupees 20 lakh plus category would be the cream area to target e-passenger vehicles, and any good vehicle launched in that price point should, subject to the features, should be looked upon seriously.
Basudev, I wonder how you're looking at CV, because when I'm looking at your top picks, it's in two-wheeler and PV. I don't want to talk stocks. I mean, I'm not sure if you're permitted to do that, but just give us a perspective, CV versus PV versus two-wheeler. What's the pecking order for you?
So see, actually after almost 2.5 dull years, where CV market, both in terms of volume and tonnage per vehicle, which saw a contraction, post-GST cut was going through a revival phase. And in fact, nobody expected 20% plus growth in second half of FY26 for the MHCV market. And now, since March, when the Middle East crisis started, your fleet owners have been fearing that, okay, your diesel prices are moving up, freight demand might suffer a bit because of geopolitical issues. So postponement of demand fears have been creeping in. But the good part is, if you look at retail CV numbers since March till July, double-digit growth is still persisting. But compared to cars and two-wheelers, the quantum of raw material within bill of material for a commercial vehicle in terms of crude and crude derivatives is relatively higher. For example, tires constitute a significant chunk of bill of materials of heavy trucks. And as you know, natural rubber has moved up almost 40% plus in last 4 months, from sub 200 rupees a kg to 280 rupees a kg. And that has been resulting in rising tire prices. So those things have resulted in higher capital cost increase for trucks, and the fears of profitability in coming quarters with the Middle East crisis still persisting to some extent. So I believe the moment there is clarity on culmination of Middle East crisis and Brent prices further correcting, natural rubber prices correcting, definitely CV business outlook will improve, and that should get reflected in performance of the stocks.
And would you prefer auto OEMs versus auto Ank? Is there a preference in terms of how you would play the current cycle?
See, frankly speaking, one can't differentiate in that manner. It depends upon the business model. All auto and companies have their unique business models, unique product portfolio, unique cyclicality, and capital efficiency of many of them are quite different. So you just can't compare, frankly, between the OEMs and ANGs separately. Yes, there are few very well diversified ANG players with consistent free cash flow generating capability, M&A intensity being good, and entry barrier in terms of innovation capability being good. So those companies definitely continue to do well and become good compounders in due course of time.
All right. Thank you so much, Basudev, for coming in and speaking to us, giving us that perspective. Always good to take a bit of a step back post earnings and get a sense of how you're looking at things. Looking forward to the next one as well.
Thank you.
Thank you. Okay. What we'll do is completely timed out. So we're going to thank you. Midcap Masala will take all the action forward. It's a goodbye from Sajid, myself, and the whole team who puts this show together. Thanks so much for watching.
Happening with some of the companies from there in terms of their earnings or other news and updates, and also give you a sense of some stock specific buzzers. Speaking of which, at the index level as of now the market is slightly subdued. We're seeing cuts of about 0.4%, and immediately at open we had slipped below the 24,500 mark. We're just shy of that mark right now. Remember, yesterday we were able to cross that 24,600 mark, so right now we're at least a good 120-130 points lower from yesterday's close. Sensex too lower by about 0.5%. It's Nifty Bank that's seeing slightly elevated cuts, 0.8% lower on that index. The broader end is a mixed tale today as well, because yesterday the small cap index was under pressure and the mid cap was doing well. Today that trend has reversed. The mid cap index is absolutely flat with a hint of a negative bias. The Nifty small cap index is higher by about 0.2%. Sectorally, it's a mixed bag coming in. Metal, pharma, oil and gas, auto, realty and IT are doing decently okay for themselves. Nothing too major over there in terms of gains, but on the flip side, Nifty Bank, Defense, FMCG, PSU banks are under pressure with cuts between 0.4% to 0.8%. From the broader end of the market, you've got a lot of stocks that are buzzing on either side right now. The advanced decline ratio on the Nifty 500 is slightly in the favor of the declines, 280 stocks in the red and the rest in the green, with the biggest cuts today coming in on Triveni Turbine. We'll speak about that, followed by Jubilant Pharmova, Castrol. ABFRL continues to reel under pressure for a second straight day post its weak set of earnings that it reported over the weekend. That's the tilt of the market right now. But taking you through some stock-specific buzzers from the broader end, it's Gland Pharma that is surging after a strong Q1 earnings performance and positive management outlook, with revenue up 20% and PAT jumping 47% year-on-year. The management has maintained its FY27 growth target of 15% constant currency and is evaluating roughly 20% growth over the next 4 years, while working towards their 30% EBITDA margin target, supported by CDMO expansion and new complex injectable opportunities. Meanwhile, Lumax Auto is also in focus. It is in fast lane today after reporting strong first quarter results, with revenues rising 33% YOY and profit more than doubled to come in at about 100 crores. The company also reported 156 crore Chakan plant to cater to new Mahindra orders, with peak annual revenue potential of about 440 crore rupees. The stock is up a solid 16% in trade today. Okay, and moving away from that, on the flip side, Triveni Turbine, like we were highlighting earlier, that stock is under massive pressure after its Q1 net profit fell 20% year-on-year to 51 crore rupees, despite its revenue rising about 20%. Order bookings have grown 6% with strong export and aftermath traction, but the sharp decline in profitability is something that's weighing on the stock. The stock is lower by 6.25% as we speak. And shifting focus to Amara Raja Batteries, then the stock is seeing strong gains of nearly 6.5% after solid first quarter performance, with revenue and profit both posting healthy growth. The new energy business also is expected to scale up strongly, adding to investor optimism around the company's long-term energy transition opportunity. And shifting focus to Jupiter Wagons, that one is in focus on the back of multiple order wins, including a 400 crore rupee BESS project. Multiple order wins over there from the West Bengal State Electricity Distribution Company and additional 211 crore orders from JSW Port Logistics and Orissa Alloy Steel. The BESS win takes the company's BESS order book to 500 crore rupees as the company aims for 1,000 crore by FY27 end. And Dixon Technologies is in focus after the company received a 295 crore order from the Ministry of Defence, further strengthening its defence order pipeline. The latest win adds to the company's strong order book with execution that is expected to support growth going forward. The stock is up 3.25% in trade today. Okay, that's on Dixon Tech, and the other stock that's seeing similar gains, 3.5% uptick coming in on Bosch today. That one has delivered a strong Q1, beating estimates across revenue, operating profit, as well as its bottom line. The comparable quarter had a 556 crore rupee exceptional gain from the sale of its businesses, making the reported profit comparison less meaningful. Avi is joining us with the number crunching for Bosch.
So the Bosch came out with its Q1 FY27 numbers, and it is strong on all fronts since the revenue is a beat and EBITDA and PAT all a beat on all the fronts. Talking about the numbers, their sales was 5842 crore rupees, operating profit came in at 818 crore rupees with a margin of 14%, which is a expansion basis the estimates, with net profit coming in at 702 crore rupees. The PAT is inflated because of a 225 crore rupees deferred tax impact that the company has recorded. It is also important to note that there is an exceptional gain of 556 crore rupees in the comparing quarter of last year of Q1 FY26. The exceptional gain of 556 crore rupees was due to the sale of video solution, access and intrusion communication systems business in Q1 FY26. So the Indian automotive industry, which is the major business of Bosch, concluded the quarter gone by on a resilient note, attributed to supportive domestic demand and a low base effect despite the ongoing West Asia war crisis. So all in all, a decent set of results, not that great as it looks on the first go, the numbers, because there is an exceptional impact and a deferred tax impact, making the numbers neutral on a YY basis.
Avi, thanks so much for joining us with all those details. But let's shift focus to Goldiam International. The stock is in focus after reporting strong set of numbers. The stock, in fact, is up 6% as we speak. Revenues have risen 42% YOY, with margins expanding to over 20% in the quarter gone by. So what aided this and what changes with respect to the outlook for FY27? To discuss this, we are now joined by Mr. Anmol Bhansali, MD at Goldiam International, who is now joining us. Mr. Bhansali, morning. Shesha here, and thank you for taking your time out. And the first quarter clearly has been very good for you. And let's understand how your guidance for the full year changes, because you had earlier guided for double-digit growth for the full year FY27. And now that you've reported very strong performance in the first quarter itself, would you like to revise your guidance upwards?
Good morning, Shesha. Thank you. We're very happy to report our all-time high and all-time best Q1, both in terms of revenue as well as EBITDA and PAT. You would be appreciative of the fact that Goldiam has, over the last 4 or 5 years, over tripled our revenue base and even faster increased our bottom line and PAT. This is driven by deepening presence with large US and global retailers that we service as a fine jewelry OEM of choice. Regarding FY27, we've come off a record FY26 here. And while our expectations were to have a double-digit growth, we certainly continue to maintain that, though, of course, we are even more confident and looking forward to drive that and hopefully beat that as well as we step into a robust Q1 for FY27 and hope to continue our momentum with this strong growth in the coming quarters as well. Just to share very quickly, Shesha, Goldiam being largely a company that sells to the US market, we have Q3 being our largest quarter in terms of seasonal sales. So we'll certainly see robust momentum as we continue forward into this fiscal year.
Understood, Mr. Bhansali. Hi, this is Snehi also joining in. You did say FY26 was a record year for you. Even before that, you've seen growth between 25 and 30%. Could this be a hat trick here where growth exceeds 25% for you?
Thank you, Snehi. We certainly hope so. The Q1 numbers have been very encouraging and we've beaten Q1 quite significantly as compared to Q1 FY26 While of course this quarter has a one-off of about 22 crores with respect to tariff and duty reimbursements that have come in. Even without that, we have had a very, very significant growth north of 35+%, 40%, both in revenue as well as in our PAT numbers. So we hope to continue our momentum as we see order booking strong, higher than last year. And as mentioned, we look forward to a robust Q2 and the key holiday season of Q3.
Okay, so the momentum continues to remain strong. Mr. Bhansali, you spoke about exports and the fact that US continues to remain a big market for you. What kind of growth do you expect in exports going forward? And other than US, which other markets are likely to aid that growth?
Sure, thank you, Ashesha. So at Goldiam, about 90% of our sales come from the US market. That is by far the largest and most profitable jewelry and fine jewelry market for B2B vendors that are like us in the diamond-studded jewelry industry. Outside of that, we are hoping in this fiscal year to introduce a couple of markets like Australia, deepen our presence in Canada, as well as deepen our presence in new markets that have already delivered certain numbers in Q1, like the Middle East, Israel, etc. So these are pockets where we believe there is certainly a lot of growth left ahead for us. However, having said that, the core focus of the company by large will continue to remain in the US market, given both its size, scale, as well as its profit potential. Outside of that, of course, our retail business, Origem, is continuing to build very nicely. Today, Origem stands at about 26 stores, being amongst the top 2 largest lab-grown retailers in the country. And we hope to continue that momentum moving forward as we move into and go deeper into FY27 and FY28.
Understood. In fact, my next question to you was on Origem. Just trying to understand how the lab-grown pricing is playing out on ground. What is that doing to demand? What is that expected to do to your margins? And also, you did speak about Origem. You had earlier said that you aim for each store to break even within 6 months. Is that timeline online right now?
Thank you, Snehi. So at Origem, we've, and generally also for the industry, now that 90% of Goldiam sales comes from lab-grown diamond-studded jewelry, we feel very confident on the inherent product itself of lab-grown diamonds. At wholesale, we see a very strong base of pricing with further price erosion not even being a factor that we believe will continue into the future. In fact, over the last 2 quarters, we have seen lab-grown diamond prices increase for certain sizes, particularly the smaller sizes of diamonds, as compared to the prior base. So I think the sort of erosion of price that was a factor that we were navigating in FY22, 23, 24 is certainly a matter of the past now. At current rates, we believe it's a great time to invest in inventory and, of course, then utilize that loose diamond inventory in fine jewelry distribution globally as a B2B company and in India as a B2C company. With respect to our plans at Origem, we hope to continue our store expansion. The trajectory of break-even is more or less in line with some stores, yes, and certainly mall-based stores hitting those numbers as we had shared earlier in con calls, and high street stores needing further development, which we're working on an ongoing basis to make our brand a full stack retailer. So work continues, and as that does, we're happy to keep sharing updates.
And we'll keep interacting with you more often to get those updates. Mr. Bhansali, thank you so much for taking your time out and joining us here on ET Now. On that note, we need to slip into a very short break, but Ramky Infra will join us after this very short break. Stay tuned. We were interacting with the management of Goldiam International. Now time to put the spotlight on Ramky Ramky Infra, shifting from one sector to the other. Slightly softer set of numbers this time around. The revenue was up 24%, but the PAT has taken a knock of about 47%. EBITDA is lower by 62%, and we've seen a very massive EBITDA margin contraction too, to just 6.1% compared from 20% this time last year. So let's understand what has caused this softness. More importantly, what's the outlook on recovery and the growth ahead? We've got Mr. Sunil Nair, the CEO of Ramky Infra, joining us on the show. Mr. Nair, hi, good morning. Just trying to understand what happened in the quarter gone by, what has caused such sharp contraction in your bottom line as well as your margins, and what's the outlook on recovery?
Good morning. Thanks for having me.
Morning.
Yeah, our first quarter performance reflects the strength and discipline of our execution engine. On a standalone basis, we grew revenue by 27.5% and net profit by nearly 31% year on year. Most importantly, our consolidated operation swung back into profit on a sequential basis after a soft fourth quarter. If you compare with the last quarter had some exceptional items, which are basically stake sale of one of our operating assets, so it's not comparable. So if you exclude that item, we grew 5% on our top line.
Okay, and the order book position at the end of the first quarter, Mr. Nair, stood at about 9,000 crores. Now that we have already 40 days in after that, what is the order book currently? What is the bid pipeline looking like? And how have order inflows been so far this quarter?
As of today, the backlog stands at 12,000 crores overall. The pipeline is pretty strong, both in India and internationally. We're bidding on a number of projects in our water wastewater segments. We are bidding on the industrial parks in India. So we overall see the momentum. We see a good growth in our top line and bottom line this year.
Okay, looking forward to that. Mr. Nair, you did say the order backlog is at 12,000 crores right now as we speak. How much of that is executable within FY27? What will the revenue contribution be from your existing order book, and how much of it will spill over to FY28?
Currently we estimated that all of these revenue which are going to come from our existing order backlog, we haven't factored in the new order books. Obviously, in the quarter 2 and 3, we expect a significant order inputs. But our plans are generally, it's on the existing order backlog, which are substantial. So that will translate into revenue this year.
And what will your FY27 revenue guidance be from about 1850 crore of revenue that you reported in FY26? Now that first quarter has been very strong, the pipeline looks very good. What kind of growth should we expect for the full year?
We don't give any guidance in terms of numbers, but I can tell you that with the current backlog, there's going to be significant growth in the top line and the bottom line.
Okay. And Mr. Nair, between water, industrial and urban solutions, can you give us a split of your order book? And more importantly, where you see, within which segment are you seeing the most growth potential?
Significant order backlogs are in water wastewater. If you look at that, that would be in terms of water wastewater would be around 5,000 crores. Industrial parks would be around the 6,000 crores, and the other segment contribute another 1,000 crores.
Okay, and Mr. Nair, how has government tendering been shaping up? That's the first part of the question, and also on international expansion. I believe you were also focusing on that, especially the Middle Eastern region. Has there been any impact of West Asia?
Okay. Government tenders, quite a number of tenders are currently we are working on the water wastewater sectors and industrial parks in India. Where in the international market, we are focusing largely on the water wastewater, especially in the Middle East market. We don't see any slowdown. There are bids gone in the UAE. There are bids going into Qatar and Saudi Arabia. So we don't see any changes as of today in our, the order books.
Okay, that sounds good. Lastly, Mr. Nair, while your standalone debt is nil, the consolidated debt on the books of the company is around 830 crore rupees. Can you help me understand where is the debt in the company right now? What's your plan to start repaying some of it?
You see, we are monetizing our stabilized assets. These stabilized assets, future revenues, we have a build, own, operate and HAM model project, new projects. So we are reinvesting this back into these large BOT and the HAM projects, which we have won in the last quarter. So there are stabilized assets, which has a steady future revenues. You have to be monetizing them.
Okay, so that's the outlook for the next few quarters. Mr. Nair, thank you so much for taking your time out and joining us here on ET Now.
Thank you. Thank you.
And with that, it's a wrap on this edition of the show. Thanks so much for tuning in. Buy now, sell now will come up next.